Today is February 6, 2024, and I'm just going to go through some charts to show where the market is sitting right about now. And we'll just start off with the real rate. So if you're able to get a return on your investment in treasuries or anything to deal with interest, it's been a long time since you've actually been able to get a real amount of money. Ever since the GFC, it's just been real slim pickings since interest rates were so low for so long. Inflation rate was higher pretty much. So here's the zero break even, where anything above this you're making very little, so like 0.7% after taxes. You're really not making anything by putting your money in treasuries or savings account or anything like that. You were actually losing money for a while through this inflationary period after they printed a bunch of money. And so recently you've been able to save money, and what that means is a lot of people take money out of the stock market and put it in savings account where it's safe. You don't have to worry about a stock market crash. And what that does is make the stock market very tip-topsy, since a lot of big money and a lot of hedge funds and stuff like that will start taking money out of the stock market. It can get crushed real quick since it's not backed by solid money. So that's one chart. Let's take a look at the Dow. This is the Dow Industries divided by the CPI, and the CPI is what inflation. I'll just show you real quick what the CPI looks like. So, oops. Shoot, this is not what I wanted to do. Let's go here. Put the CPI in here. So this is the CPI. So basically this is the US dollar over time. It's buying power of the US dollar. So through here we're in a gold standard. The dollar kept value real good. It got destroyed right here. Roosevelt stopped having ties with the gold standard. So ever since then the US dollar has just been losing money, losing buying power. The only reason it's valued at it's still $1.04 as of today is because it's in a basket with other bad currencies, and they're just all losing value at the same time. So it appears to the public that the dollar is holding its value. This chart really shows that it's not. It's losing at a very fast rate, especially through here. You can just see the buying power get crushed. So that's the CPI. So what I did is I took the Dow and then divided it by the CPI. So this is the Dow, inflation adjusted Dow, and right now we're making a double top on it. So it shows as of right now that the Dow is above, and I think it's like up in here somewhere, but when you inflation adjust it, it's down in here. So double tops are real prone areas to losing. We'll take a look at lumber. Lumber's just been getting crushed. It looks like a trend right here, so maybe there'll be some support. What in the world? So maybe we come down to this area, a little bit of support there. And for some reason it doesn't, like here's the GFC. I mean, lumber came down a little bit, but it doesn't get real crushed. It stays pretty strong. I'd imagine people start stocking up if it gets too cheap. Take a look at the inflation. This is my meter that I've designed. You don't see this on the big news stations or from anyone really. So it just shows population over time, and it shows the money supply, which is M2. So how much money they have put in the system. And you'll see real inflation periods like through the 80s, late 70s and 80s, when there's more money than people, then the population is growing, you'll run into inflationary periods. So right through here, there was way too much money in the system. Right here, we got below, and that's why we're holding rates for so long. And then inflation came roaring back as soon as you had more money than the population. So now that we're going underneath it, looks like it should be back to normal. Probably hold underneath for a while again. So that's good. That's a good indicator for inflation. Take a look at the bonds and interest. This is I never thought we'd be able to get above this, to be honest. They just printed so much money that they've been able to raise rates higher than I expected they'd be able to. Because you can see in like 2018, right through here, they talked about raising rates, and this is the S&P 500. You can see it dipped real hard because they were going to talk about raising rates, which would have blown through this chart, and the market panicked. But we're able to get through it. So, but there is some key indicators in this chart, and it shows that whenever it starts rolling over, when this is a moving average, EMA. So when this crosses, it's usually when you get a recession. So that's what all these black lines are. Crosses, you can see this the spider, the S&P 500, whatever you want to call it, starts to roll over. So here's an area. Here it crosses, starts to roll over. Here it crosses, rolls over. And we're just getting to that point where it should be crossing real soon. I don't know. Looks like it could be March, April, somewhere in there. And we'll probably see it roll over once again. But you'll see that this trend has changed now. We were in this lower, and now we've went higher. So we've broken this wedge that we had. So who knows what that brings. It probably brings a lot of inflation from now on, is my guess, and higher rates from now on. So that's what we'll expect. I can't imagine it gets down into this wedge area again. I mean, maybe it goes negative rates because of a super big depression or something, but I think they're going to have to keep printing more and more, and it's going to do less and less. That's what that chart shows me anyways. This is housing priced in gold. So ever since the GFC, it's remained in this channel. And it's just the price of houses divided by gold. So either it can go up or down. Right now it's in the center, so not a big deal. It seems like housing is priced accordingly with gold. Debt to GDP. So it's an interesting chart. We can just take off gold right now. So, or you know what, we can leave gold on there. Let me show you something. So when the debt gets more than the GDP, like through these areas, when the debt's getting to be too much than what we're producing, gold tends to do really well, especially ever since the dot-com bubble right here, where they starting to print a lot of money every time we get into a downturn. So right here, you can see the GDP is the debt to GDP is rising, and then gold just goes crazy. That's the yellow line. Again, right here, starts going up. That's a problem. Gold is very good when it comes to fear. So if there's a lot of debt in the system, gold tends to do well, because the currency will get debased. And we can see that the bottom trend of this debt to GDP is towards the bottom right now. They've been tightening for a few years now. This is going to end, and then as soon as QE comes back, it's going to start going up, and gold should do extremely well through that time. Let's take a look at the next one. This is the SPY divided by money supply. So how much money is in the system, like I just mentioned. This is the S&P 500. So the more they print, the more stocks are going to go up. You can see that they keep injecting money, but the market isn't done too much. This is what I'd consider like the real S&P 500, according to how much money's in the system. So Nothing too much. If you want to be a little bit bullish, it looks like it could come up to this area, and then get rejected and come back down to this trend. This trend's been going a good solid 10 years, so it's possible. If you want to be a bull, it can go up this high. A little bit of room yet. And if we just kind of keep this chart going, this is again saying May, April, May, somewhere in there. It'd be topping out. Consumer sentiment. Now this is very interesting. This is a Michigan survey. They take a survey of how confident people are, and it's pretty accurate actually on how, as soon as consumer sentiment dies, the market dies, and it can actually be a little bit like right here. It's forward leading. It's actually starting to break down before the SPY even breaks down. Same with right here. It did the opposite. So this is what I'd consider a bubble, when the consumer sentiment is getting crushed because people don't have money. Gas prices were going crazy high through this area. You had COVID, and the market just kept going because they were printing all that money. So that's you can see that it actually broke this trend, which is interesting. So it actually broke, confirmed, and now it's coming back up. So the next report's going to be kind of interesting. Possible we get one more to keep this trend, and then we'll see where it goes. But more of the key level, more than anything, is what's real interesting about this chart is because it's broken all the way back to 1980 on how bad consumers felt about the current situation. So, I mean, that's worse than the GFC. It's worse than the dot-com bubble. I mean, pretty bad. So consumers are not real happy, even though the stock market's breaking new highs. So this is how much the Fed's balance sheet. So how much money they have on their balance sheet versus how much money they've printed. So when their balance sheet gets real big, it becomes a problem, and you'll start losing labor. So this is a great chart to see when labor is going to start getting squeezed. So right here, their balance sheet is getting too big. Or I'm sorry, there's too much money according to their balance sheet, and it starts to roll over, and you can see right through here, labor just dives off a cliff, and same with right through here. You can see that the labor starts to roll over. I mean, this chart was we were doing so good for so long that COVID, it was just so quick that it never had a chance to get underneath it. But you can see we're curling through again as of right now. So if this is any indicator of what happened through this area, I would expect labor to get crushed. And you can see the labor is already starting to roll over. Even though they tell you there's so many jobs in the economy and blah, blah, blah. That's because people are getting part-time jobs and losing their full-time job because companies are cutting back. So we'll go to delinquency rates. This is a very good chart. You can see delinquencies always come up before recession. This is dot-com bubble. Delinquencies were popping up. And this is Fed funds. The orange line is Fed funds. So as they raise the interest rates, delinquencies go along with it. Same with right here. It doesn't happen right away because they're raising rates because the economy is doing well. So people aren't getting delinquent at first, but then eventually the rates for so long catch up, and then people getting behind on bills start going up. Same with like right here, you'll see eventually catches up, and then they cut, and then it rolls over, and delinquencies come back down as soon as they give people the ability to get loans again. So what we see here is they've really raised the Fed funds rate like I just showed you in that other chart, and delinquencies are coming up, and they're coming up fast. It's actually, if you chart it out, it's the worst. Delinquencies are the worst since 2012 and rising. So as soon as they start to cut, you're going to see rates always, the delinquencies always come after they start cutting, because they see it coming, so they start cutting first. So recession always comes right after they start cutting, right here, and eventually here. Wages, this is interesting too, and it's more for, this is more of an inflationary chart. So when you have more wage growth than GDP, you'll get inflation too. So right through here, hourly wages were increasing more than GDP through here, and it's always after they print, of course. So holding pretty steady actually, but you can see wages are falling behind GDP a little bit. And GDP can also be real high just because of inflation too. The more prices are, the more GDP you produce year over year anyway. Gold, this is a very good chart if you like gold. I highly recommend gold. I think it's a great asset. There's no third party in gold. It's worked for 2,000 years plus. People are real negative on gold right now, which is an excellent time to be buying. They say that gold has done so bad over the last 10 years, but if you would have bought gold in this 10-year period, you would have went from $200 to $2,000 in 10 years. So of course it needs to come back, and it needs to just sit a little bit and build up for the next push. So this is they call this a cup and handle pattern. So when it comes down and then pulls back, it can't pull back more than 50%. So right here we were getting very close to 50%. I was buying as much gold as I possibly could through this area right here. And now we've came up, and we'll take a look at this chart. So you can see the trend. This is the SPY. So when the Spider SP500. So soon as gold gets crushed enough, people have their money in the SPY because there's more money to be made in the S&P 500, especially after they print. You get a better return. But soon as the return starts dying off in the S&P 500, people look elsewhere for money to be made. So that's when this trend breaks. You'll see gold do extremely. This is a gold chart. You'll see as soon as it breaks, gold just goes crazy. Same with here. You come down, broke trend right here. Gold absolutely crazy. So now we have another trend coming down, and as soon as this breaks through, I expect gold to go crazy. I mean, that's, what is this, 80 years, 90 years of charting for gold, and it's been perfect. So don't believe the media or whoever you hear saying gold's bad. It's done extremely well. It's outperformed the S&P 500 for the last 20 years. Let's see. I wanted to show one other chart right here. Now this is the 10-year treasury minus the 2-year treasury. This is what they consider the smart money. So big smart money knows when to get in and out of treasuries. And if they see a recession coming, they want to get in treasuries. They want to get that 5% real yield that I was just showing earlier. Well, the real yield's 2%, but the interest rate's 4 or 5%. So they want to get in that, locked in that, and then sit through the recession and wait for the recession to get through until they start printing, and then sell off their treasuries and buy stocks again. And smart money knows this stuff. They have the programs to see it. They have all the information. So it's hard to beat smart money. They've always been right. This is going back 30 years, 40 years. It's predicted every recession there's ever been. So right here you'll see this trend breaks. This whole trend breaks and it starts going straight vertical. You'll have a recession right through here. And then this trend breaks, you'll have a recession right through this bottom as it starts to go up. This one breaks, you'll have a recession right here, which is funny because I predicted the 2020 recession. COVID, it predicted COVID. I don't know, coincidence, I don't know. But you'll see this is the GFC right here. Here's a better example of it. This is the Fred. Great website if you never go to the Fred. You can type stuff in here. Whatever you want to see, labor statistics or whatever you want to see, has charts for almost everything. So the gray area is the recessions, and you'll see that every time this breaks and starts to go up, it's a recession. So this trend breaks, recession, breaks, starts to go up, recession. Now one could say that it has this topping pattern, maybe like through here. So maybe it goes up to here and rolls over one more time, and that'd be years out, but I don't think so. I think this is so low. Like all these low spots are recessions. I'll show you on this chart. So recession, 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 recession. I'm just gonna call it. So. And you will see that it normally does this little spike at the bottom. So this little spike and then sells off for maybe, I don't know, a year, it looks like. Like through this area is usually about a year. So we actually broke trend right here. So we're, this is again saying May, like we should be in this area right here. So I'd expect bonds to do real well. Coming up, could pull back one more time, and then I would expect bonds and gold to just do extremely well through this area. And this is predicted at every time, so very interesting chart. Something to keep an eye on. I think that's really about it. That's most of my charts, so hopefully got some good information out of this video.